First of all, I would like to introduce the keynote speaker, Fabio Balboni. Fabio Balboni is senior European economist at HSBC. So his speech is on the quest for stability and growth, an international view of the national economies. So, over to you, Fabio.
Good morning, everyone. It's a pleasure to be here to deliver the keynote speech. This conference is about risk management, so I will outline a little bit what is our view for the global economy and particularly Europe over the next few months, but in particular, of course, highlight what some of the key risks are and how we think, they could impact the economy and how they could impact the market. So if I can start sharing my presentation, I would like to kind of show you first that, we've seen already a number of events this year. I don't know if you can already... Perfect. Thank you very much. So despite the sort of, a number of risk events that have already happened this year, of course, and over the recent past, wars, tariffs, election surprises, this has not prevented actually global growth to remain fairly solid. So if you look across kind of the main economy in the US, but also in the Eurozone, we see a little bit of an uptick in terms of growth. So certainly so far, the story remains one, as I said, despite several risk events, despite a considerable amount of monetary policy tightening that we saw, of course, over the last couple of years in order to stem the rise of inflation that we saw on the back of the energy crisis and the back of the COVID pandemic. Growth seems to be remaining reasonably solid. So that's, it's a good place to start. But of course, as you will have seen probably, particularly over the summer, markets are getting a little bit more concerned about what's going on in terms of growth, and particularly in the US most recently. So on the chart on the left, I'm showing you some of the activity indicators, in particular in the ESM service, which, as you see, the manufacturing has been pretty weak. This is pretty much of a global story. I'll come back to that also when we talk about Europe and Germany specifically, but also the services sector has been trending down over the last few months. And particularly the chart on the right shows you something that you might have heard a little bit over the summer, the so-called SAM rule, which suggests that once the unemployment ticks up above that black line, the US tends to head into a recession. So that's what got market worried about the prospect of a possible imminent recession into the US, and to price a considerable more aggressive pace of rate cut by the Fed over the next few months. Now, what I would like to remind you, however, is that, of course, the unemployment rate has been ticking up over the last few months in the US, but this is also because of a much bigger immigration story. So as you see here, the line on in red, so the increase in foreign people into the US labor force has been impressive over the last couple of years. Of course, the more people join the labor force, the more you create growth, the more you create consumption. But of course, there's also a risk that as people adjust and enter into the labor market, you might get a bit of an uptick in terms of unemployment rate. So I think this context is very important to keep in mind, and to understand why, at least so far, we're not too negative over the prospect for a possible looming US recession. It does, however, also mean that we're not so confident that the ECB that the Fed will cut rates maybe as aggressively as markets expect. So the market are still pricing in a 50-50 probability of a 50 basis point rate cut by the Fed in September. We think actually that the Fed will move a little bit more gradually. The chart here shows you that core inflation in the US, this is the measure that the Fed has been looking more closely, has certainly come down with respect to the height that we saw in 2021, 2022, but remains uncomfortably high. In fact, yesterday we had one data print for August, again, a little bit higher than what market had anticipated, and that suggests that the Fed will adjust rates down. Fed Chairman Jay Powell has been pretty clear about that recently, so we expect a 25 basis point cut in September, but we don't think they will move as aggressively as the market has been thinking. And of course, on top of that, there is a big element of uncertainty risk. Maybe we'll have an opportunity to come back to that on later during the Q&A, which is given by the US election, significant uncertainty there. We just saw the debate a couple of days ago. It's neck and neck, and that could also have important implication in terms of fiscal policy. Of course, major fiscal expansion in the US could help support growth. It could also mean potentially risk from an inflation perspective, and that could again push the Fed to be a little bit more cautious in terms of downward trajectory on rates. And another important implication that the US election could have is on global trade, of course. What we've seen most recently in global trade, as you see in this chart here, is a little bit of a growing momentum. So this is positive, of course, for exports, Eurozone export as well. The Eurozone tends to be an export-driven economy. But what this chart shows you is that actually part of the uptick has been quite specific, in particularly if we look at Taiwan exports, which we tend to see as a leading indicator of global trade, has been very specific in certain sectors, information, communication, technology, audiovisual, so it's been quite sector specific, quite geographically and region specific, particularly in the Southeast Asia. Europe hasn't been benefiting as much so far by the uptick in global trade that we have seen, and we'll come back to that point in a second. And as such, we do see a bit more of a rising momentum in global trade, but we think that overall that still remains fairly subdued. And of course, as I mentioned before, there are some risks potentially attached to the US election. Maybe we'll come back to that later. But as you know, Donald Trump has been talking about the potential for a 10% tariff to be imposed globally on product. And that, as the chart on the left shows, comes on top already of a significant increase in tariff recently, hampering global trade. And that's not the only story. The other thing that we've seen significantly increase recently is subsidies. Of course, subsidy, we can be open or more hidden. But as you see, these have been an important element hindering global trade and producing also some backlash. We saw recently, for instance, the decision by the European Union to impose tariffs on Chinese electric vehicles on the back of perceived subsidies in production there. So certainly, this is another important element of risk when it comes to global trade. And certainly with the US election, we could see an increase in the risk of potential tariff hampering exports, and in particular Eurozone export. Now, last, before we turn to Europe, I just wanted to mention, of course, a couple of things regarding China, because China has been one of the missing part, really, of global growth over the last couple of years. We've seen a significant deleveraged trend. There was a significant housing bubble in China that meant that housing investment has been negative, or even very negative. You see the gray line on the left over the last couple of years. And while it is starting to recover, or at least stabilizing, this is happening very, very slowly. So this took off a very important engine from Chinese growth. The good news, however, is that some of the other engines are starting to fire again, and particularly if you look at industrial production, has been quite strong so far this year. Also, manufacturing production has been quite strong. So certainly, some of the kind of the stimulus, the very targeted stimulus measures the Chinese authorities have put together to try to reignite domestic growth have been successful. We should, however, keep in mind that it does remain a relatively subdued environment for domestic consumption, and you see on the chart on the right where retail sales so far this year has been relatively weak. That also justifies the kind of slightly disinflationary trend that we've seen in China so far. And also the other important development to note is that it is a different type of growth from China. So for instance, it benefits much less traditional export partners such as Germany, and we'll come back to that in a second. So if we can now turn to the old continent, to Europe. What are we seeing here is also a bit of a slowdown in terms of the growth momentum. So the chart on the left in particular shows you the latest PMI. So as you see, a bit of a downturn into the summer, then a slight reversal into August, but we suspect there's a bit of an Olympic boost there. France was particularly strong in August. But overall, as you see, our latest expectation for Q3, we suspect, there might be some downside risk there. So we see growth momentum slowing a little bit into the Eurozone, not necessarily enough to lead us into a recession, but certainly something that leaves us a little bit concerned. And one important factor when we think about Eurozone growth is the behavior of households. And one of the key driver of growth, at least in our view this year, should have been consumption. Of course, households have been affected by fast increases of inflation over the last couple of years, but now inflation has come down significantly, is getting closer to the ECB aim of 2%. But in the meantime, wages are increasing well above that. Wages are increasing in the region of 4 to 4.5% in the Eurozone. So that gives people a nice little boost in terms of real wages. The missing part of the puzzle, however, is that people are saving more. So rather than consuming, as you see in the chart on the left, savings ratio are picking up significantly among Eurozone households. So that's hindering a little bit one of the key growth engine that we thought was going to drive Eurozone growth this year and next. There's several reasons for that. Again, maybe we can come back to that later. One is possibly the increased level of uncertainty. As you see on the chart on the right, there's been a significant wedge opening up between economic uncertainty in the US and Europe, particularly since the Ukraine-Russia war started, and that might push people to be a little bit more cautious in terms of their spending decision. There's also, of course, demographic factors such as aging population, low fertility rate that might kind of push people to save a little bit more. One thing that, at least from a European perspective, and particularly in consumption, we're not too worried about is the potential for stock market correction. Of course, we saw some sharp correction, particularly at the beginning of August. As you see, stock prices are all-time high in the Eurozone. So we do see a potential for further correction in the future that could certainly create some volatility on the market. But as you see on the chart on the right, Eurozone households, relative, for instance, to their US counterparts, they don't tend to put too much of their savings into the equity market. And that reduces a little bit the sensitivity on consumption to stock market changes. That instead, of course, could be a much bigger issue in the US. So if you see sharp stock market correction over the next few months, that could also have an important impact on consumption and growth, and as such, once again, push central banks to move a little bit faster in terms of cutting rates. This chart shows you one of the other traditional engine of European growth, that is trade. And as I was hinting before, it doesn't seem that the Eurozone is benefiting as much as it would have done in the past from the uptick in global trade. So Europe has been consistently losing market shares over the last couple of years. And this is something that we will come back in a second, because it's one of the key challenges for Europe going forward. Certainly, Mario Draghi, in the reporting presented on Tuesday about the future of Europe and how Europe can increase its competitiveness, that is one of the issues that he highlighted more in detail. The good news in terms of exports has been instead tourism, where we've seen sharp increases in tourism, including from non-EU, which are increasing in double-digit figure so far this year. So that certainly has benefited growth, particularly in the periphery country. And as you see on the chart on the right, we're already well above pre-pandemic levels in terms of tourism. So digging a little bit deeper into the manufacturing and the trade story that I was hinting before, as you see, this has been a pretty bleak story for European manufacturing since the pandemic in particular, and even more so since the Russia-Ukraine war and the energy crisis, which the subsequent energy crisis. And as you see on the chart on the right in particularly, German manufacturing production has been on a sharp downward trajectory, and the energy-intensive industry has been hit particularly hard. As the Draghi report highlighted, the cost of energy of firms, the energy cost of firms in Europe are now 2 to 3 times higher than their counterparts in the US. So this is a very important structural challenge that could even kind of put into risk the survival of some of the most energy-intensive firms. So this is something that Europe will certainly have to address in terms of how to facilitate and enable firms to access energy more cheaply. And of course, given the lack of resources, this is something that will require a significant amount of additional investment. Draghi was talking about around 800 billion per year of additional investment to tackle the energy and digital transition in Europe. We've also seen a shift away from what, for instance, Germany produces best. As you see here, in terms of the global demand for German cars has been reduced significantly, particularly with the transition towards energy vehicles. And also, as you see on the chart on the right, part of the competitiveness edge that Germany had gained in the early 2000s with the very deep labor market reform that were undertaken has been lost recently with the relatively sharp wage gain. So that also explains a little bit of the weakness that we've seen in terms of Germany manufacturing recently. The good news is that, we should be past the peak in terms of the intensity of the monetary policy transition. So if you see on the chart on the left, we start to see a little bit of an uptick in terms of lending growth from banks. Remember that banks lending is very, very important in Europe. 90% of firms' debt is through the banks, and as such, once we start to see a bit more of an uptick, that should help growth. The chart on the right shows the credit impulse, which is the difference of credit between one quarter and the other. So more credit should help a little bit reignite the growth cycle in Europe, and it should also help a little bit at the margin the housing market. We're not overly optimistic about the housing market prospect in the near term, as you've seen, with the exception of Italy, but there was a huge incentive schemes to support housing construction over the last couple of years. Every country has been pretty much in a downward trajectory. That's what you would expect in an environment with higher rates. And certainly the prospect, the near-term prospect, as you see on the chart on the right, do not look too strong there either. So going very quickly into the kind of the ECB, as such, what do we see in terms of the ECB? Well, the ECB is facing a situation where wage growth remains relatively high, as you see there in the chart on the left. Productivity is quite low. We'll come back to that in a second. And as such, unit labor cost, which is the cost of producing one additional unit of output, they are very high, as you see on the chart on the right. And that means that particularly in the services sector, where labor is 50 to 70% of the total cost of the firms, well, it's proving very hard to reduce some of the price increases that we've seen. And indeed, as you see, the kind of the momentum, which is the black bars in terms of services inflation, rather than going down, has actually gone up since the beginning of the year. And this, in our view, justifies once again the fact that the ECB as well will likely move quite gradually in terms of the rate cut. So, for instance, we see the ECB cutting rates today in a few hours' time, but we see them skipping the October meeting. So quite gradual reduction in terms of rates, and you see that on the chart on the left here. At the same time, they will continue to shrink their balance sheet very aggressively. This could cause a little bit of liquidity issues, particularly when it comes to some of the weaker banks in Europe. The last point I wanted to flag a bit more broad is this issue of productivity as mentioned before. As you see here, there's a huge gap opening up between productivity in the US and the Eurozone, but also the UK. This has been particularly evident since the global financial crisis. And in our view, the bulk of it comes down to investment. As you see, investment since the global financial crisis nearly doubled in the US, while in the Eurozone, we're only 20% up. So that explains, in our view, a huge amount of the gap in productivity. This is a structural issue, something that will have to be addressed in the future with more public and private support. And as you see here, the weakness of productivity is pretty much a story across the board, particularly since the pandemic. And this was certainly something that was highlighted very much in Draghi's speech yesterday. And part of the reason, in our view, is that while the Eurozone generates a lot of resources through their external account surplus, when it comes to recycling those resources domestically, we see that many of those end up sitting in cash, deposit, and they not necessarily feed through to the kind of the growth cycle of firms. Indeed, one of the things that the Draghi report found out is that where Europe is really failing is not necessarily at the level of copyright, patents, but at the level of scaling up the enterprises when they need when they need funding for scaling up for the unicorns, they tend to move to the US. Last point is on fiscal policy. As you see on the chart here, it's a little bit of a complex chart, but basically what this shows you is that most countries have now reverted back to pre-pandemic GDP levels, but they have a much worse fiscal situation. That could also pose a challenge of the future, of course, because that means countries will have to issue a significant amount of debt with less excess liquidity, as I was showing before. And that means that there's a significant amount of fiscal consolidation to happen over the next couple of years, particularly with European fiscal rules coming back. One country we are particularly concerned is France on that front, where we've seen consistent upward revision of the fiscal deficit over the last couple of years. And of course, the political situation there, with government uncertainty, a weak and fragile government, makes it difficult for them to address this situation. Luckily, there's still a lot of money to be spent, as you see from this chart here, from the Next Generation EU plan. As you see, particularly some of the periphery economy, we're getting north of 10% of GDP of Next Generation EU resources, which can be spent by 2026. So that should provide a nice little support to investment in particularly, and offset some of the impact of the domestic fiscal policy tightening. There starts to be a little bit talk about the possible next Generation EU tool. Draghi has been talking about it. That's maybe something we can discuss later. I think that would be very, very important, particularly to provide some of the common goods like electricity network, like infrastructure, like railway network across Europe that cannot be provided or will not be provided at the domestic level. But I think politically, at least for now, I find it hard to believe that they will be able to agree a new Next Generation EU, a new joint debt tool over the next couple of years, particularly given the current political situation in Germany, France, but also other countries. And I'm going to stop here. So if there's any question, I will leave you with this last chart, which shows you that, despite, as I said, this kind of relatively benign growth environment so far, there's plenty of risk, which we discussed, that we have to be aware over the next few months. Thank you very much.
So great. Thank you very much, Fabio, for your insights and very comprehensive overview on the macroeconomic situation. There is a question coming in, and obviously, and not surprisingly, regarding the U.S. elections. And would you expect from U.S. and European view regarding the current reaction to a possible election of Donald Trump versus Kamala Harris? What are the signs that you're recognizing in the market?
Yes, I'm not surprised. This is, there is a question on that front. This is one of the most topical subject that we are discussing also with investors at the moment. I mean, the polls are very, very close, as you saw. There seems to be even a little bit of edge, particularly after the debate 2 days ago, heading into the Kamala Harris direction. The implication will be very important, of course. There are some domestic implications. I hinted before, fiscal policy. Donald Trump in particular has been talking about a considerable fiscal expansion in the US. That could possibly mean higher rates for longer. Of course, if you get another fiscal boost, that could push up inflation a little bit. So that might force the Fed to be a little bit more hawkish in terms of cutting rates. And then, of course, we also feed through to the other jurisdiction. That could also mean the ECB is a little bit slower in cutting rates. But on the other end, we might get a little bit more growth support. Another important implication could be on tariffs. As I hinted before, Draghi has been talking. Trump has been talking about a 10% possible tariff. According to the IMF estimate, that could knock off about 1 percentage point from global trade growth. And in turn, of course, that could reduce Eurozone growth by about 0.3, 0.4 percentage point. And of course, it could hit particularly certain countries most exposed to the US. And depending on what type of products, again, the axe will fall. So that could be a significant risk for Europe. It could also boost a little bit of protectionism across the globe and potential backlash for Europe. Of course, in all likelihood, Europe will retaliate. There are some tools now available at the European Commission to retaliate in such cases. So we could see a bit of a further increase relative to what I showed you before in global protectionism that could nip in the bud the nascent global trade recovery. There are, of course, important geopolitical implications. Trump has been talking about leaving Ukraine as soon as possible. That could put Europe in a difficult position. The positive side of it is that it might be a bit of a increase the sense of awareness of Europe that they need to spend more on defense spending. This is something we're hearing more in Europe. It could be an opportunity also in terms of developing its own infrastructure, defense infrastructure, and we've seen Europe in the past acting in times of crisis. So with some of the risk, there could also be some opportunities coming.